The current trading status for Hanesbrands Inc., ticker symbol HBI, is effectively halted as of this morning, Monday, December 1, 2025. The stock last traded at approximately $6.63 per share before suspension, and if you are looking at your brokerage screen right now hoping for a tick, you are going to be waiting a very long time. The ticker isn't just paused, it is being retired. The Hanesbrands we knew as a standalone public entity has officially ceased to exist as of today. This moment right here is the ultimate tension between expectation and reality. The expectation for months has been a will they, won't they regarding regulatory hurdles or a last-minute bidder for this iconic American apparel giant. Many of you holding HBI in your Fidelity investments accounts or tracking it on Robinhood stock trading apps were likely expecting a standard trading day or perhaps a final squeeze. But the reality is far more definitive and, frankly, historical. Gildan Activewear has officially completed its acquisition of Hanesbrands today. The buy button is gone, the sell button is gone. If you held shares as of the closing bell on Friday, those shares are currently undergoing a mandatory conversion. You are no longer a Hanesbrands shareholder. You are now part of a much larger cross-border textile story. It is rare that we get to talk about a stock on the exact day it vanishes from the New York Stock Exchange, but that is exactly where we find ourselves. This isn't just a quarterly earnings miss or a sector rotation. This is the end of a corporate era for a company that traces its roots back over a century. The reality today forces us to look not at the next support level, but at the finality of the exit. The market expected a simple merger. What we got was a complete absorption that redefines the global innerwear landscape. So let's sit down and really unpack what just happened to your portfolio, because the mechanics of this deal are specific and you need to understand exactly what is hitting your account. The deal structure that closed today converts each share of Hanesbrands you owned into 80 cents in cash and 0.102 shares of Gildan Activewear. This mix of cash and stock means your investment hasn't just been cashed out, it has been rolled over. You have been involuntarily, but perhaps profitably, transitioned from betting on a standalone turnaround story to becoming a partner in a massive vertically integrated manufacturing machine. To understand why this happened and why the stock is sitting at that final $6.63 valuation instead of the $20 or $30 highs we saw years ago, we have to strip away the brand nostalgia and look at the cold, hard financials that drove Hanesbrands into the arms of its Canadian rival. The general belief, the common ground most retail investors stood on, was that Hanesbrands was too big and too iconic to fail. We are talking about a brand found in 8 out of 10 American households. Surely, a company with that kind of market penetration could pivot, cut costs, and survive on its own. But that belief ignored the massive anchor dragging the ship down: debt. Hanesbrands spent the better part of the last decade trying to grow through acquisition, buying up businesses in Europe and Australia, and trying to leverage its supply chain. When interest rates were near zero, this strategy looked brilliant. You borrow cheap, buy revenue, and service the debt with cash flow. However, when the Federal Reserve began its aggressive hiking cycle, that variable rate debt became a noose. The company was paying hundreds of millions in interest expenses that should have been going into marketing or product innovation. This is where the contrarian take comes in. The acquisition by Gildan wasn't a rescue in the sense of saving a dying business. It was a predator consuming a wounded competitor that had excellent assets but a broken balance sheet. Gildan didn't buy Hanesbrands for its management team or its debt strategy. It bought it for the shelf space. By acquiring Hanes, Gildan instantly secured dominance in the North American underwear and sock market, locking out competitors and gaining massive pricing power with retailers like Walmart and Target. Let's look at the recent price action leading up to this final halt. Over the last 6 months, HBI stock has been tethered to Gildan stock price because of that 0.102 exchange ratio. Arbitrage traders, the sharks of Wall Street, have been keeping the two stocks in tight lockstep. Every time Gildan moved up $1, Hanesbrands moved up roughly 10 cents. The volume we saw last week, those massive spikes in trading on interactive brokers trading platforms, was not retail investors buying the dip. That was institutional capital, hedge funds, and merger arbitrage desks positioning themselves for the closing we are seeing today. They were buying HBI to convert it into Gild, essentially buying Gildan stock at a slight discount. If you were holding HBI because you believed in the champion brand turnaround, you likely missed the exit ramp a year ago. Remember, Hanesbrands already sold the global rights to the champion brand to Authentic Brands Group in late 2024. That was the first domino. Management realized they could not fund the marketing required to keep Champion cool while simultaneously servicing their debt. They sold the crown jewel to pay down the credit cards, leaving Hanesbrands as a pure-play innerwear company. That divestiture was the signal that HBI was no longer a growth stock. It was dressing itself up for a sale, and today that sale is complete. Now, let's talk about what this company actually was until this morning. Hanesbrands was unique in the apparel world because it owned its own supply chain. Most clothing companies like Nike or Lululemon are just design and marketing firms. They contract out the actual sewing to factories in Asia. Hanesbrands, however, owned the cotton fields, the spinning mills, and the sewing facilities. They made their own stuff. This owned manufacturing model is great when you're running at full capacity because you capture all the margin. But when sales slow down, those factories become massive fixed costs that burn cash every single day. Gildan, the buyer, operates the exact same way, but more efficiently. Gildan is famous for its low-cost manufacturing hubs in Central America and the Caribbean basin. They are the kings of the blank t-shirt market, the printwear business. By plugging Hanesbrands' massive volume into Gildan's hyper-efficient manufacturing network, the combined company expects to save hundreds of millions of dollars. They're not going to keep 2 HR departments. They're not going to keep 2 logistics networks. They're going to strip Hanes down to its brand equity and its customer contracts and run the production through the Gildan machine. For those of you using SoFi Invest or Fidelity mobile app to track your portfolio, you might be wondering, what do I do with these Gildan shares I'm about to get? This is the pivotal question. You are now holding stock in a Canadian company that dominates the North American basic apparel market. This is a very different investment proposition than the distressed turnaround play you were in yesterday. The new entity, let's call it Mega Gildan, is a cash flow monster. With Hanesbrands' debt largely refinanced or paid down by Gildan's stronger balance sheet, the combined company will generate significant free cash flow. This is the kind of stock that dividend investors love. It's boring, it's stable, and it sells products that people buy regardless of the economy. You don't stop buying underwear during a recession. However, there are risks. The apparel sector is brutal. Cotton prices fluctuate, consumer preferences shift, and there is always the risk of integration indigestion. Merging 2 massive corporate cultures is never easy. Hanesbrands was a marketing-led company. Gildan is a manufacturing-led company. If the sales team from Hanes gets frustrated with the cost-cutting culture of Gildan and leaves, you could see a drop in sales relationships. Apparel is still a people business at the buyer level. The relationships with buyers at Target, Costco, and Walmart are crucial. Also, do not ignore the global supply chain risks. Both companies rely heavily on cotton grown in the Americas and manufacturing in Central America and Bangladesh. Political instability in those regions or weather events like hurricanes hitting the Caribbean basin can disrupt production overnight. This concentration risk is now doubled because both companies operate in the same geographic zones. There is also the antitrust angle, although since the deal has closed, we're past the danger zone. But being this big puts a target on your back. If the new company tries to raise prices too aggressively, regulators might take notice, or retailers might retaliate by bringing in new competitors. So, where does that leave you, the former Hanesbrands shareholder? You're standing at a crossroads. The ticker you watched is gone. You have a little bit of cash in your brokerage account from the 80-cent payout, maybe enough to buy a nice lunch, and you have shares in a Canadian giant. The smart friend advice here is to reassess your goals. If you bought Hanesbrands for a high-risk, high-reward turnaround, Gildan is not that. Gildan is a slow, steady grinder. It's a defensive play. If you want excitement, you might want to take your capital elsewhere. But if you want a piece of a monopoly-like dominance in basic apparel, you sit tight and reinvest the dividends. Ultimately, the Hanesbrands story teaches us a valuable lesson about leverage. Debt magnifies returns on the way up, but it is fatal on the way down. Hanesbrands had a great brand, loyal customers, and good products, but they let the balance sheet get away from them, and in this market environment, the balance sheet always wins. As we close out this script, remember that while the HBI ticker is dead, the products aren't going anywhere. You will still wear Hanes t-shirts, the profits will just flow to Montreal instead of Winston-Salem. The